Good day to all. This will be our discussions involving PS40 investment property. And this time it will be more or focused more on computations. So we can see here certain problems that we are going to tackle one by one. Hopefully you're ready. This is our illustration number one, and it's asking us to determine the total investment property. And here are the line items or the account titles which are provided. Let us always take note that if you're asked about investment property, we focus on land and building only. So let's begin. Our total investment property would only be land held for long-term capital appreciation as discussed. We want the value of the asset to increase over time. Also, if the intention is not yet clear and the purpose is undetermined, but it will be, of course, used in the future, but not yet clear. And with that, we can say, or we can simply say that it's still focused more on increase of the value. Next is building leased out under operating lease. But if finance lease, the owner would be the other entity that is renting the property or leasing the property from us. And in that case, that will be out. Also, the right of use asset relating to a building held by the entity and leased out under an operating lease. So this is a case wherein the lessor rents a certain property, like this one building, to another entity, and that entity is the lessee. On another contract, that lessee rents it out to another entity. So it's like there are two separate rent or lease contracts. And in the second situation, this is what is the solution or the example here, that it is just the right of use of the asset because the lessee in an operating lease contract is not the owner. So just the right to use. And this is called usufruct in our legal or law courses or subjects. I'm pretty sure you know the spelling, but let me just tell you it's USUFRUCT. That's usufruct. All right. For a total of 3,700,000 pesos. We have to take note that if the land is held for future plant site is the term that is for the use of operations of the business. Therefore, that's PPE. Equipment is out, only land and building again. So that will be part of PPE. Also, the land held for sale in the ordinary course of business, that is actually part of inventories. Then building leased out under finance lease is not part of the asset of the entity. So that will be part of the asset of the lessee. Lessee who is becoming the owner. Next, illustration 2. What about for the total investment property of the following parties? So we have ABC company having the following assets. Then the requirement is to determine how much is the total investment property. Only, again, the building that is leased out under operating lease will be part, as well as the building that is rented out under operating lease. Building constructed for a third party is under PFRS or IFRS 15 for construction contracts. Then building under construction or incomplete building that is to be used when finished as part of office, or the building rented out to ABC's employees will pay rent at market rate. So basically that is going to be still part of the operations of business and therefore property, plant, and equipment. If it is for sale, just like for this one, office building awaiting disposal, that is clearly part of our held for sale. So that is part of PFRS 5 if ever it is really held for sale. But if it is just a building that is to be disposed at the end of its useful life, that would be part of PAS or IAS 16, property, plant, and equipment. All right, so hopefully you got that, and you need to pause for now for a minute to absorb the details. Another situation is when, for example, a portion of a certain building, for example, is going to be used for operations of the business and another is for rental purposes. So what will be the treatment? As discussed, we just have to look into whichever portion is significant. If the significant portion is for the operations, that's PPE. If the significant portion is for actually rental purposes, then investment property, if and only if the portions cannot be sold separately. But here in illustration 1, the portions can be sold separately, meaning to say we just have to classify them and we are going to allocate the cost of the building or carrying amount based on, let's say, the number of floors dedicated for IP and the number of floors dedicated for OCP. So we can see that here that this is a 4 million 10-story condominium building. So I will give you also a minute to be able to read the problem. Should be pausing this part here. All right, and now we are done with the minute and let's go over with that particular question. So 4 floors are rented out under operating lease and the rest office space. So the 6 floors, meaning we can develop fraction 4/10 since there are 10 stories in the condominium building, and then 6/10 for the owner occupied property or the PPE. So that's 4M times 4/10 and 4 million times 6/10 to get the two amounts accordingly, 1.6M and 2.4M. If not sold separately, so as said a while ago, we have to look into which portion is significant. So example, let's say in this particular case, if we can check this out. So again, you need to pause at this point in time to be able to read the problem properly. And now we're back. So we can see here that this 100,000 square meter mall has a rentable space of 80,000 square meters, and the 10 square meter space is occupied as an administration office. The current amount of the building is 10 million pesos. So what should be classified as investment property? We have to take note that the significant portion, 80,000, is rentable. Therefore, that's rent revenue, which is another venue for the business to earn. And that is called, or that is part of investment property. But the OCP or PPE, because it's just 10 square meter space, so basically that's really insignificant. It's not even a 10,000, it's really 10 square meter space. So in that case, really insignificant, therefore 0 for owner occupied property. Now, the entire property is classified as investment property because the owner occupied portion is insignificant in relation to the whole, as said a while ago. Now, also, guys, we have to take note that this is with the consideration that the property here is basically investment property if ever it's another way for the business to earn. Because if it is a business that is really engaged with renting out premises of the building, meaning that's the main line of operations, that's really PPE, and this analysis would not be relevant anymore. So always take note of that. Now, what about ancillary services? This is discussed also. I will give you also a minute to go over with a question. Now, in this part here, illustration 1, the ancillary services or peripheral or additional services basically are insignificant since the building is rented out under operating lease, and then the service is security and maintenance, which is just little, and it's not the primary line of business or the operations of ABC company. Take note also that leasing is not the primary business of ABC, and that's the time that we are going to test whether it's IP or PPE. And because the ancillary services are insignificant, it's really IP, investment property of 1 million pesos. Now, what about for a hotel? I think I explained this in the first video, just for the lecture, that if ever the ancillary services, like for a hotel, when services are basically part of the operations of the business, And so it's going to be considered and be forming part of our cost of owner-occupied property or property, plant, and equipment. All right. Then, for the sake of combining or consolidating financial statements of the member companies in a group, such as, for example, a parent that has an investment of at least 50% of the shares of another company that is subsidiary, then the investment property will become owner-occupied or PPE should we consolidate the financial statements. However, for their individual financial statements, especially for the parent that is basically leasing or which is leasing or renting out the property to, let's say, the subsidiary, on the part of the parent, it should be investment property. So here's an example. I will give you also the time to have this like in a minute, and you should be pausing this part here. And we're back. So question is, how much would be presented as investment property? ABC Company owns 90% interest in XYZ Incorporated. So ABC Company is the parent, while XYZ is the subsidiary. And then ABC, the parent rents out or rented out, meaning the lessor, to XYZ, the subsidiary, also the lessee. The current amount of the building is 1 million pesos. IP becomes 0 on the consolidated financial statements. But on the parents, again, financial statements, the 1 million pesos will be classified as investment property. All right. Next would be, what about for initial measurement? For initial measurement, as said, we are going to measure investment property initially at cost. And then we have to capitalize directly attributable costs. For example, if that is purchased, then all costs needed for the asset to be ready for its use. If construction, then all items like raw materials, direct labor, and factory overhead that are needed for the investment property to be finished for its intended use. Let's begin. So there are basically 4 items, and the question is, how much would be the cost of IP on initial recognition? Let's dissect one by one. For the purchase of the building, which is to be held as investment property, no doubt it's really investment property, but the question is how much? That's 1 million pesos, direct cost of 20,000, and of course, the cost of day-to-day servicing is to be X'd out or not to be included because it would not actually add more benefits to the investment property. In addition, the IP is already ready for its use. So that would be 1,020,000. All right. Second, for the construction, that would be IP, it's stated here, obviously. Then add materials, labor, and overhead. Startup cost X, operating losses X. If ever the waste would be normal to be added as part of the cost, but if abnormal, meaning this would happen in cases of ineffective and inefficient management and operations of the construction companies, in that case, to be X'd out as well, the latter 3. Therefore, it should only be 2 million pesos. Next, what about for land acquired for or with currently undetermined future use? That's really for capital appreciation, therefore IP. And then there is an issued note payable with face amount of 1 million, but with the present value of 800,000. Now, for cases of installment, especially with the notes payable, if ever there is no cash price equivalent, then we are going to use the present value. The cash price equivalent is the fair value, actually. So we use 800,000 only. Now, for the fourth one, what about if exchange? In an exchange type of acquisition, just like in the discussions of property, plant, and equipment, we are going to capitalize the cost of the land, for example, or any IP with the fair value of the asset given up plus any cash difference. And that is 3 million pesos plus 500,000 payment. We normally do this cash difference in order to balance, but not perfect, about the fact that on the part of the payor, which is our company, that would be the difference that should be paid, so that 3 million plus 500,000 will be close to 3,600,000. And also we can notice that it's not really going to be really perfectly balanced. It's just close. So it's having commercial substance because this is really a sale transaction. All right. And on the part of the seller, of course, that would be a certain thing that we have to take note also. All right. Then question is, how much is the total cost of investment property? Let's check if we are correct with our analysis then. So I will also give you a minute to think about it, if ever you will have the same answers as mine. And indeed, we have the same answers as what we've discussed a while ago, for total initial cost of investment properties of 7,320,000 pesos. Next, for this one, what about for the models? Well, as said, initially, or initial recognition, we are going to record investment property at cost. But for the subsequent recognition, then we are going to analyze, should we use cost model or fair value model? Should we use cost model, we can still, of course, move to fair value model the next time. But if we are using fair value model, then we can no longer get back to cost model. However, for the two models, we really have to know the fair values of our investment properties, provided that they are, of course, available in the market, or we can know such. And also another thing is that for cost model, so follow IAS 16 or PAS 16 provisions. So the carrying amount will be cost less accumulated depreciation and impairment losses. But for fair value model, once we're going to make use of that, no depreciation, only the differences of fair values, and the fair value minus cost for the first year ending, for the next year's ending, second year and onwards, the difference of fair values. So let's look at this problem. And you should be pausing this particular video as of this moment. And now we're back. So entity A acquires a building for 10 million pesos and spends an additional 3 million so that it would get into the condition for its intended use. And that would make the cost as 13 million pesos, 13. The building is available for lease on January 1, 20X1, and then the useful life is estimated to be 20 years with no residual value. On the end of 20X1, the investment property's fair value is 12 million pesos. If we use cost model or fair value model, no question, initial measurement really is at cost. The concern now is for the subsequent, meaning for ending of the first year and onwards. So cost model, that would be cost less accumulated depreciation. And the debit for accumulated depreciation, remember, this is contra non-current asset account, and this is the, of course, expense portion, the debit. So that's 650,000. This is first year, that's why the two are equal. Now, what about for fair value model? Whether we use cost model or fair value model, we have to know the fair values at the end of each reporting period. If under cost model, we just have to disclose such in the notes. If fair value model, that is to be used because we have to deduct the amount of the fair value 12 million minus 13 million. Therefore, there is a loss at the end of the first year. And we can see that computation here. So normally the formula is fair value current minus the fair value before. So 12 minus 13 is -1, and the negative is an indication of loss. This formula here is somehow like a reversal, but then if you just know the concept, then you will still get whether it's a gain or loss. Even if with this illustration, we can see that the value decreased at the beginning and end from 13 to 12. Therefore, there is really a loss. All right. And we can see here the summary that for initial measurement, the same. For subsequent, it would be different for carrying amount and of course, under fair value model, and we can see the impact on the statement of profit or loss, or the statement of comprehensive income with the statement of profit or loss section. So depreciation expense under cost model, fair value model, 1 million pesos. Unrealized loss, of course. Next is, what about for fair value model? Kindly pause at this point in time. And now we're back. So for fair value model, this is how we are going to make the entries. Just take note though of the cost, 1 million, useful life 10, residual value 100,000, fair values respectively at beginning and end. And then the building is sold on December 31, 20x1, cost to sell would amount to 50,000. And we use straight line method in depreciating its PPE. All right, so let's continue. In this case, for initial recognition, it's going to be at cost. The fair value is disregarded at that date. But at the end, it's at 1.3 M minus 1 million equals 300,000. Again, the 1.2 M fair value at January 1, 20x1 is disregarded. Then take note that depreciation is not recognized. For the purposes of computing fair value, the cost to sell is not actually deducted. Take note, the word is fair value model. Fair value less cost to sell is another thing that is closely related to net realizable value. That's another thing. It's different from fair value. Then this unrealized gain is part of our income section in the statement of profit or loss section under the statement of comprehensive income. Next, illustration 3. What about for change in accounting policy? Carrying amount is 1.1 M for ABC company. Fair value is 1.3 M. Case number 1. What about there is a movement from cost to the fair value model? In that case, we just have to get the difference of the fair value now and then the value also before. Now for this one, if you are following the discussions, you might be wondering, where is this 300,000 obtained? Because we are just given here the values as follows. So 1.3 M minus 1.1 M. That would be supposedly 200,000 if we treat this as separate transaction. But if this is, for example, a continuation of the previous problem, we can actually compute that after the end of a year, the value would be 1 million. Let's say this is 1,100,000, and using the same formula for computing depreciation straight line with salvage value of 100,000 and useful life of 10 years, so that would be 1 million. So that's why it's 1.3 M minus 1 million and 300,000. But I guess this is independent, so it should be 200,000. Now, what about for case number 2? If we move from fair value to the cost model, what would be the gain or loss and what would be the entry? First and foremost, we have to take note that it is not allowed. Therefore, no gain or loss and no entry to affect the change. Then it's going to continue with the depreciation method that was considered prior under the best effective method that can be used for depreciation. Also, the reason for the accounting standard to rule out this way is that the movement from cost model to fair value model is actually improvement for financial reporting. It would result to more relevant presentation. But if we move back from the improvement, which is fair value to cost model, basically it would not enhance our financial reporting and presentation. Therefore, not allowed. Next, what about if the company has inability to determine fair value reliably on initial recognition? So in that case, here's the concept. I need you to read first the problem and you pause for a while. And now we're back. So for the concept, when the fair value model is used, but the fair value of one investment property cannot be reliably determined on initial recognition, that investment property will be measured under the cost model. Then the rest, fair value model. But for the purposes of depreciation, the residual or scrap or salvage value is assumed to be zero, even if there is actually in this problem. So in that case, that would be 1 million cost and disregard residual value of 200,000. So still 1 million divided by 10. That will be the depreciation expense. And as soon as we can determine the fair value the next time, then follow the concepts here for case number 1, especially the journal entry and amount. Now, what about if it's really inability to determine the fair value reliably after initial recognition? Like this is the case. So I need you to read this problem in a minute. The situation here is that firstly, we can determine the fair value, but afterwards, because of certain changes beyond our control, especially in the active market, then we can no longer determine the fair value. In fact, it is stated here, the related active market ceased to exist. So is ABC company permitted to change to the cost model? No, a big no. Once we move from cost model to fair value model, or once we use the fair value model initially, then no turning back, no going back, or no usage for a certain reporting that would become less relevant because of such change. So in that case, then we have to make use of the fair value model. Exceptions would be, example, if we recognize or sell the property or reclassify it to another classification, like from investment property to PP or inventory. And this is going to apply even if comparable market transactions become less frequent or market prices become less readily available. And query number 2, so what shall ABC company do then? So in that case, there is a hierarchy under PFRS 13. The title of this standard is fair value measurement, wherein we can still determine the fair values out of these 3 items in decreasing priorities in the hierarchy. So first, for the possible inputs will be current prices in an active market for properties of different nature, condition, or location, adjusted to reflect those differences. Since we cannot determine the readily market for this asset or this land or this building, for example, then look for similar, let's say land or building, but in different nature, condition, or location. And then that's an active market. Next is if we cannot find an active market, then similar properties on less active markets with adjustments, of course, especially if those prices were from years ago. And we know discounting. And letter C, it's really discounted cash flow projections on the cash inflows that can be obtained out of using such or out of still keeping the property for rent purposes or capital appreciation. So discounting there is very important. Next, for impairment, this is another field. And this is to be discussed exhaustively under IAS 36 in finals. In impairment ruling is that number 1, we are going to impair only non-current assets. Investment property is part of that. Number 2, it should be that the property or non-current asset is not valued and presented using fair value method or approach or model. So investment property then using cost model is to be tested for impairment, and in case that the recoverable amount is lesser than the carrying amount or the opposite, carrying amount exceeds the recoverable amount, then that would result to impairment loss. However, if investment property under fair value model, then no. And this one is interesting. If ever, for example, there is a compensation from a third party, so a sort of receivable, a claim, if ever that IP is impaired, lost, or given up, then we have to recognize in profit or loss when we receive that. So normally we debit, for example, the receivable, claims receivable, and we are going to credit claims income or revenue, for example. Then the loss event, that would be another entry. Compensation with third party, which is what we are talking right now. So that's another entry. and if ever there would be subsequent acquisition of a replacement asset. So we have to recognize them also separately. To the recognize is when we are going to dispose the asset and no more future economic benefits and or actually expected from it. To recognize any gain or loss on disposal, remember the formula, that's fair value, so the cash or the proceeds less the carrying amount. If self-constructed investment property, then we have to capitalize all costs, direct materials, direct labor, factory or construction overhead needed for the investment property to be finished or done or completed. However, if the waste resources would be abnormal, to be expensed immediately, which was discussed a while ago. And that's the end for our discussions with computations. Hopefully you got something from this session, everybody or everyone. Thank you very much, and God bless us all always.